In the past 2 days, we've gotten results from all of the big national banks, JP Morgan, Wells Fargo, Bank of America, and Citigroup. And I got to tell you, the market just can't stand it. In just the last 2 sessions, JP Morgan stock is down more than 5%. Bank of America is off almost 6%. Citigroup shed over 4%. Sell. And Wells Fargo has just been hammered. So what the heck is going wrong here? I got to tell you, it's not the numbers. Most certainly not. You know that the actual numbers were good? I think it's a combination of high expectations and some cautious commentary, as well as the aforementioned presidential assault on credit card debt. When JP Morgan reported yesterday, they posted a solid top and bottom line beat, excluding a $2.2 billion reserve that they took related to the Apple credit card and portfolio that they got from Goldman Sachs. These guys delivered a 7% increase in net interest income with 17% growth for their markets business. That's fantastic. That's mostly sales and trading. Just stock trading was up 40% alone. These are amazing. But the investment banking business came in light, down 5% year over year and 11% from the previous quarter. That weighed down by weakness in both debt and equity underwriting, and that was just plain bad. Of course, even when the numbers are pristine, the reaction of JP Morgan's earnings hinges on the conference call commentary from CEO Jamie Dimon, who's become the almost Confucius-like figure for the financial industry. And he often says things that really do freak out people. Something that happened again yesterday. This time, Jamie warned that, I'm going to quote, geopolitical is an enormous amount of risk, end quote. And he also had some things to say about ballooning budget deficits in the United States and around the world. Maybe that's why, after opening flat, it was actually up $5 in pre-market trading. The stock ultimately tumbled more than 4% yesterday before slipping another 1% today. I think JP Morgan's stock will be fine. A lot of this was simply because the stock had rallied 35% over the previous 12 months before yesterday's report. In other words, it was due for a breather. What about today's reports from the other three bigs? Okay, Wells Fargo, which we own for the Travel Trust, reported top and bottom line miss. While sales were up 4.5% year over year and earnings grew by 13%, they still came in light, as did net interest income. It was disappointing. That said, a big chunk of that earnings shortfall came from higher severance expense, as well. Wells Fargo, by the way, laid off a lot of people to cut costs. When you drill down, the business is doing pretty well, just not quite as well as Wall Street and I were hoping. Wells Fargo's efficiency ratio, a key measure of cost, fell from 68% to 64%. Lower, by the way, is better when it comes to that measure because it's cost divided by revenues. But the analysts, spoiled by CEO Charlie Sharp's relentless cost cutting, were looking for 62.5%. Just not good enough. Now, imagine that told a story of a bank that's been unshackled after last year's removal of the Fed-mandated asset cap of 2018. Wells Fargo is now able to grow more aggressively in areas like credit cards and investment banking. And again, you've got to keep in mind that the stock was up, like JP Morgan, 35% over the preceding 12 months. That's one reason why we sold some Wells Fargo for the Travel Trust yesterday. Even in the teeth of the hideous decline, more on that later, I still believe in Wells Fargo longer term. But the stock has to finish going down, and I don't think it is yet. All right, how about Bank of America, which looked fantastic? They posted a small top and bottom line beat with a 7% revenue growth, 18% earnings per share growth. Astounding. Their net interest income was up 10%, also slightly better than expected, yet the stock still sold off 4% today. I think that's extreme. Don't let that mislead you. Bank of America reported a solid quarter. All four of the business lines, they beat revenue expectations, with global wealth and investment management and global markets both up over 10% year over year. I'm not used to seeing that. Bank of America also sounded confident about 2026, guiding for 5 to 7% net interest income growth this year. CEO Brian Moynihan said, quote, while any number of risks continue, we are bullish on the U.S. economy in 2026, end quote, and thank you. It's tough to poke holes in this Bank of America quarter. Sure, the company got a boost from lower than expected credit charges, which helped drive their slightly better than expected earnings beat. Like JP Morgan, their debt and equity underwriting was light. That was disappointing. But really, taken as a whole, I think this was a really fine quarter for Bank of America, maybe the best. And the stock only got hit today because Wall Street paints out with a broad brush. This decline was, I think, pure guilt by association. I'm pronouncing it innocent. Bye-bye. Last but not least, there's Citigroup, which delivered another good, solid quarter, the latest in a long line of no-drama results under CEO Jane Fraser. Excluding a one-time charge related to the bank's sale of its Russian operations, Citi saw 8% revenue growth, while earnings per share were up 35%. Citi had the best net interest income of all the banks, up 14%, also ahead of expectations. But as with Bank of America, they benefit from a smaller-than-expected provision for credit losses, which signals confidence in the economy. But it's not an operational number. Below the top lines, this is where it hurt. It was a mixed bag. Citi's services business and its banking business both beat. So did the markets business. But that was driven by fixed income as equity trading fell a bit short. The company's personal banking in the United States had a shortfall, and I was hoping that would start cutting. I like that business. It needs to really climb, as did the wealth unit, though the wealth shortfall was very small. Basically, for Citi, this was another professional quarter. And for a turnaround story like this, it would have normally been enough to send the stock roaring. Remember, Citi's much, 3 much cheaper than its peers, even after shooting up 66% last year. But today, with the overall market down and Wall Street deciding these bank earnings were just yawners at best, another solid result from Citi wasn't enough to send the stock up. We're all used to seeing it jump after earnings. One of the more interesting tidbits about Citi today didn't even come from the quarter. In an internal memo sent to employees, which was then picked up by basically every major financial news outlet, Fraser, CEO, said that her bank's transformation efforts are more than 80% complete. Memo also included news about more layoffs and some interesting commentary about how Citi's adopting AI. But it matters that the bank's self-help efforts, which have moved the stock so much, are nearing completion. I got to wonder how long Citi stock can keep running if the company's no longer being graded on a curve. For now, though, I think it's just too cheap to ignore. It's probably the first one I would buy of the ones I just mentioned. Bank of America, too. They're both good. Now, here's the bottom line. The big national banks have all reported, and though we've seen generally strong results, that wasn't enough to prevent Wall Street from turning against these stocks. I'm not sweating this too much because the banks have had some major runs here, so I think they were due for a pullback. After looking at the numbers, my verdict is that these stocks can keep working this year as long as the economy doesn't deteriorate from here. But they are taking a breather after coming in way too hot. If we get this credit card rate cap to the sidelines, the rally will start, even maybe sooner than I expected. Oh, I expect some pain for the next at least week, maybe 10 days. Mad Money is back after the break.
Coming up, could the stars of the dot-com era be rising again? Cramer's going off the charts to see if what's old is new again. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.